there's this endless debate out there between the stock market and gold. Which one's better than the other? Why which one is better than the other? And there's various opinions out there on both sides. And really, I think it's just a matter of stripping the argument down to, okay, instead of just going off of opinions, let's just see how the math actually works. So before we get into gold versus stocks, I think important first is displaying where we are right now in the current macroeconomic environment. So as you can see here, we got the United States money supply M2. Contrary to doomsdayers, the Fed is not infinitely printing money or expanding their asset balance sheet. So over the past year, quite the opposite of what the doomsdayers and the gold bugs have been saying. We're actually curtailing money supply, right? So these metrics reflect the levers that the Federal Reserve uses to control not only money supply itself, but the economy as a large. So as you can see, obviously here it's displaying that money supply has been going down by the month, right? Now, see the high correlation between this chart and that chart, the United States inflation rate. Again, as you can see, contrary to doomsdayers narratives, inflation has been going down for over a year now. And then we have the historical inflation rate. No, we're not in hyperinflation. It's actually not too bad historically where we're at right now. And of course, as some of you may know, interest rates going up, money supply going down, asset allocations on the Federal Reserve balance sheet lowering. So this is hawkish, and there are no signs of dovish actions in the foreseeable coming months. So this is all quantitative tightening and levers used to bring in deflation, right? The opposite of inflation going up. As you can see here, here's the United States Fed fund rate. Now, this is the unemployment claims month by month rate. As you can see, this month was abnormally high. So interest rate hikes actually paused in June. Federal Reserve, they closely watch the unemployment claims. And the higher this number goes, the more risk that they can put our economy into recession, right? There's strong correlation between the unemployment and recessions. There's other factors too. That's not the only driver of recession, but it's important to acknowledge this. So the Fed watches the unemployment very closely, and this is why they paused this month, because they don't want to break anything, right? So, but they did say they will continue hikes in at least in the next year or so. And then we have GDP. GDP came out last week. We're at the 2% annual rate. So GDP in Q1 2023 was well above 1.3%. That was the estimate, right? And then the forecast of 1.4% of consumer spending was also, the analysts are usually wrong, right? Their forecasts are usually wrong. This was definitely wrong. Consumer spending actually grew more than expected to 4.2%. And this is the strongest it's been in nearly 2 years, right? So all these data points is kind of contradicting a lot of the gold bugs narratives, right? If you've been following my work, you've seen that we've been officially in a bull market in the stock market for about 2 weeks now. We're well above the 20% retracement level since October. Now we're in a technical bull market, right? So my question is, will any of the doomsdayers admit they're wrong? We hit the bottom last October, and since then so we went past the 4302 price level in S&P 500, which told you guys last month that we would. We are now in a technical bull market in the stock market. All the doomsdayers, the bonders, they're wrong, right? So before I get into the precious metals segment of this video, let's go further into the macro driver analysis. So here's an aggregate of all of that data that I was just going over. Now, there are some leading indicators that we look at in the Capital Markets Insiders Club that can kind of show you where these different data points below are going to go ahead of time. I'm not going to do all the research for you guys, but the leading indicators, one of them is not doing the greatest. One of them is doing okay. One of them is doing actually pretty good, above the historical low from a year ago. And so, but the other ones above, it's showing deflationary conditions in one of these leading indicators, at least in the next few months. I will say this is going up past the 22 low rate for now, so that is somewhat of a good sign. And then the other one, it's barely above, a good level, but this one too, it's showing a little bit of deflationary signs moving forward in the next few months. I will say consumer spending is up, especially in the US. So I think that will drive a lot of corporations' earnings up. And then we got the building permits. It increased by 5.6% the month of June. Highest level since October 2022, showing some resilience in the market coming later this year. Contrary to doomsdayers, I think the housing market will actually do okay this year, but we'll have to see. And we got the money supply, M2, as I was saying before, going lower in line with quantitative tightening conditions. Interest rates is at 5.25%. This is deflationary in the overall broad picture. And then we got the different inflation metrics. And inflation has been going down month by month, as you saw earlier on that chart, right? It's consistently doing that. So that is definitely deflationary. The other inflation metrics are also going down. So, as I was saying, now I covered the unemployment, but the other employment report showing added jobs in the month of June, and actually we added high results in added jobs, the most in 4 months, way above forecasts. Okay, and unemployment claims, again, are still unexpectedly high, but at the same time, we also have unexpectedly high added jobs. So it's not all doom and gloom. And then we got the more macro things for the US. We got the government debt to GDP ratio. It's 129%, almost flat for 3 years. Okay. Government spending versus GDP, slowing to almost normal levels, way below 2020 peak. We got interest compared to GDP. So it's at 1.87 in the median level going back to 1945. So it's not abnormally high right now. In fact, it's quite normal level. The liquidity, we're at a 2-year bottom trough in liquidity. The US 10-year Treasury benchmark, down significantly overall in time, deflationary. And then we got the balance sheet as percentage of GDP. This is below overall median, but going higher month by month, okay? Lastly, we got the GDP growth. Again, it's at an annualized rate right now, we're at 2%, which is actually pretty good. This is normal level historically. So this is well above the 1.3%, the second estimate in forecast 1.4%, right? Again, consumer spending growth accelerated more than expected to 4.2%, the strongest nearly in 2 years. Yep. So got all the sources here for you. This is not just opinion. All right. So now that we've gone over that, let's go back to the metals, because I think we should focus on that again. So now we're at the metals segment of this video. And I'm going to compare the gold to stocks, and we're going to see, by doing simple math, why the stock market is going to give you better returns. So the return on investment of gold since January 2011 to today is almost 18% return if you would have held on to gold since 2011 to today, right? But the return on investment, if you would have just bought the S&P 500 since January 2011 to June 2023, you would have been up 247%. So massive overperformance compared to gold. The return on investment on gold since January 2023, so beginning of this year, you're up around 5%, okay? But if you would have bought the S&P 500 starting this year, beginning, you would have been up almost 15%, right? So nice little side-by-side comparison here. Quite the outperformance. Now let's look at this, gold versus stocks and bonds. Gold peaked around 2011, as you can see here, almost up to the $2,000 range per ounce. Look at this, a massive, again, another demonstration on how the stock market, S&P in this example, has massively overperformed gold. Now, gold had been in a bear market for about 10 years, okay, from here to here. Gold refused to break out past this 2020 peak for now. And gold bugs have been wrong for decades. So from the 1980s to 2006, you would have had a flat return if you're holding on to gold. As you can see here, right? I mean, imagine holding on to gold that long and not getting a return on your money. So this is dead money. This is not a sufficient hedge. This is completely contrary to everything that the gold bugs say. They say that gold is the perfect hedge on inflation. Well, in the 1980s, we had a high inflation, right? And we've had inflation since the years then. But how does this, from 1980 to 2006, outpace inflation? It actually doesn't. So gold bugs, false gods like Peter Schiff, Robert Kiyosaki, they've had predictions of gold going to 10K to 100K an ounce and stocks crashing. They literally have never been correct. So now let's go to silver. Silver is all over the place, as you can see, right? Now look at this. If you would have held silver from 11 years ago to today, you're actually down, right? Negative 0.35%. This is not a good return. So, but again, the S&P 500, in comparison, you're up 247%, okay? And, if you would have bought it January this year, you're up almost 10% in silver. But again, it's so volatile that, I mean, really, this doesn't really mean anything right here. It can go down next couple of weeks. But S&P 500 has been steadily going up this year. You're up 15% right now. So look at this again. I mean, this historical chart is silver. I mean, it should tell you everything, right? So silver has been dead money. Silver price is where it was at in 1979, right here, right? Imagine holding silver since 1979, then to today, and then realizing you made a return on investment of 0%. I mean, that's got to feel bad. So again, contrary to the silver bugs, this is not a hedge on inflation. This is not stability that you're seeing right here. This is actually chaotic and all over the place. I mean, it jumps from almost $50 an ounce all the way down to 14 an ounce down here. And then it's just boop, boop, boop. So look, this is volatile. Now, another thing I want to comment on is that there is no silver short squeeze coming, okay? Talking heads have been saying a silver short squeeze will happen next month. For years, they have been wrong over and over, okay? I screenshotted some search results I got from looking up silver short squeeze. I've been seeing videos like this on YouTube for years. And how long have they been wrong, guys? Okay. I mean, look, some of these are going back 2 years ago. I've seen videos of saying this narrative from 5 years ago, right? Same narrative, years later, nothing actually happens. Okay. So what is the short squeeze if you don't already know? Well, it's a market phenomenon in which an unexpected rise in the price of a heavily shorted stock prompts large numbers of short sellers to exit positions by buying the stock, thus driving up this price further. So narrative one that these talking heads say, they're going to say, okay, well, there are more paper contracts trading silver than there is physical silver. Once this is exposed to the world, silver will go to $100 an ounce, okay? Well, I'll tell you this, the world already knows about this. So what? I mean, it's not that big of a deal. Silver obviously doesn't react to that. No one actually cares. It's a moot point. Narrative two, the banks and hedge funds short silver to stifle down and manipulate the price. Whoever says this is displaying pure ignorance of how investment banks and hedge funds actually work, right? They do not trade something for the sake of manipulating. They trade to make their investors money and outperform the year-over-year S&P 500 return, which is their benchmark. It's extremely competitive space. To lose clients' money would result in capital outflow, right? Obviously, they don't want that. So if investment banks or hedge funds do short something like silver, they have a strong fundamental disposition of why the price is going to go down, and they want to monetize on the down move. Shorting silver or gold for the sake of shorting silver and not having that based on a profitable return or fundamental reason will get you fired as a professional trader and portfolio manager, okay? So now, if investment banks or hedge funds short silver, they also may be shorting silver to hedge out their long physical holdings. That way, silver drops in price, they don't lose money since they've hedged that out. But I'll tell you this, hedge funds are not going to hold on to something like silver or really any position long term anyways. For the most part, the portfolios are more static and have changing positions in the market throughout any time. And another thing too is silver is not as rare of a commodity as people think. In North America alone, in the US and Canada, we have untapped amounts that haven't been dug out of the ground. These locations are mostly inside of military or minor controlled locations, right? So I already hear some of the gold bugs saying, oh, the stock market is too volatile, it's gambling, metals are safe. Well, guys, does this look like gambling? Does this look like gambling? Let me tell you, this is the wealth transfer right here. No, I'm not saying day trade stocks like gambler, right? You want to be a long-term investor if you're an everyday person, okay? More about that later. Silver is extremely volatile, right? I mean, compare this chart to the silver chart. If you zoom out in a long-term view, this is a lot less volatile in the long run and more consistent returns, smoother equity, a lot more consistent returns over the years. It's consistently bullish if you zoom out, and is a lot smoother equity curve for the investor. So another myth that's out there, gold and silver is a hedge on inflation and the failing dollar. Well, inflation has outpaced your returns in metals, especially gold in the last 10 years. The talking points and the narrative that gold has a bull run every time we have high inflation has been inaccurate, obviously, the last few years. Where's that bull run, gold bugs? That's what I want to know. Why isn't gold at $10,000 an ounce like you guys were saying a few years ago when we have high inflation? Obviously, that hasn't happened. So something's wrong there. Now, we have to acknowledge the conflict of interest in this metals space, okay? We got talking heads like Peter Schiff, Robert Kiyosaki, George Gammon, Novid Kaplis, Jim Rickards, Mike Adams, and other names you guys would know. They have been wrong time and time again. And they have a major conflict of interest, okay? So what they do is, this is their trick. They present the fear porn as solely rooted in rhetoric, okay? This rhetoric is very effective to engage the audience and give people their cortisol dopamine fix, okay? Their fear porn rhetoric gets you scared and dependent on them for outlooks on XYZ, like the economy, okay? But remember, this influencer space is a business model. They're pitching you talking points that'll get you to buy gold and silver and crypto, IRAs, accounts, books, seminars, and courses through their own links or affiliate links. And some of these names, they're selling all of that. And also stuff like newsletters, stuff that isn't actually going to help you, okay? So look at this. This is how long Robert Kiyosaki has been around, okay? He told everyone back here in 2009 to sell your stocks, okay, at the bottom, which would have been a horrible idea. Imagine taking this guy's advice and selling all your stocks, right, in 2009, the worst time to sell, and then you pile into gold and silver around 2010 during one of its peaks. So from 2010 to 2020, if you would have transitioned from stocks at the bottom to transition into gold at its peak, your return would have been flat and in the years between negative. Contrary to if you just would have held on to your stocks, look at all of this you would have missed out on, right? So again, if you would have just held in the stock market, let's use the S&P for example, from back here, you would have been up over 250% on your return on investment, okay? Now, ignore all this green text right here, okay? This above image was taken from another website. They're trying to tell you they can pick every bottom of the stock market. I'm telling you, anyone that says that is completely disingenuous, okay? So again, let's compare this 11-year return since the last metals peak. You would have been only up almost 80% on gold. You would have had a negative return on silver the last 11 years. S&P 500, however, again, you would have been up almost 250%. Okay. So what people overlook with metals? Well, gold and silver may be liquid. Okay. But you can only get liquidity from a dealer unless you have a private sale, which, let's be honest, guys, most people, they're not going to have a private sale on this stuff, right? So the buy and sell spread on gold and silver is not in our favor. So what do I mean by that? Well, the dealer is going to charge you a premium fee to buy the metals, right? So you're already overpaying for the fair market value when you go to buy the metals. And usually it's going to be around 10% above the current spot price, this premium. The dealer will also buy your metals, but they'll usually pay you at least 10% under the current spot price, right? Because they got to make money too. It's a business. So they're going to give you below the current spot price. So this isn't factored in when the metal buyers buy their metals through the dealers. So in your metals holdings, this is detrimental to your ROI, the premiums, and the how this all looks with the dealer, especially with silver. Okay, this is really detrimental to silver because as I've shown earlier, your returns on silver are absolutely negative or flat. It's pathetic. So dealers, this is a misconception because dealers do not care how special or numismatic or limited edition bar or coin is. They ignore all of that and will still give you below the spot price, okay? I'll give an example. One of my clients, she bought silver and gold during its peak in 2020 because everyone was freaking out. They thought the world was going to end, right? So everyone was telling you to buy metals, like those influencers I listed above. They're telling you to buy the metals, the world was going to end, right? So a lot of people believe that. They went out to the dealer, they bought some metals, and they way overpaid. My client in this example, she paid around $40 an ounce for silver, which, again, I mean, that's way too high, but that's a consequence of paying the premiums, right? So at around this time, gold was around $28 an ounce when she bought, or I should say silver. When she bought the silver, it was only around $28 an ounce, but the dealers, they were taking advantage of, the buying spree, the frenzy everyone was in, the fear buying, the panic buying. So they charged a high premium. And let me tell you, they're still doing that to this day. A lot of times it's higher than 10% of the spot price, still up to this day. So you're getting absolutely, I can't say this word on YouTube, but graped if you try to buy silver at a fair market value from the dealer still to this day, right? So we should definitely acknowledge that, and this is what everyone's ignoring, okay? So anyways, she buys at the peak. She way overpays for silver. She way overpays for gold. She bought one of the Valcambi gold bars, which, she was told this is going to be way worth overspread at a spot price of this level because this Valcambi, this special bar is rare. There's only a certain amount printed or minted, I should say. So, this is going to make her gold. This is going to make this piece of gold worth more than the spot price. Okay, but at the end of the day, she needed liquidity. Recently she needed liquidity, so she had to go sell her metals, and plus she wanted to reallocate and other things after working with me. So when she went to sell the metals, she started to realize, wow, this is a lot less than I was expecting to get back, right? So, yeah, again, because the dealers, they're not going to care how numismatic or special or limited editions your coins or bars are. They literally do not care. They're going to give you below spot price no matter what. Now, another thing too is a lot of the gold bugs, they say, well, I'm stocking up on this because the crap is going to hit the fan, right? And when crap hits the fan, my metals are going to go through the roof and in value. But you're living in a normalcy bias right now. If crap really hit the fan, your metals are worth $0. Again, your metals are valued in dollars, contrary to what these gold bugs, want to argue about. They say, well, it's above the dollar because this is real money. But okay, why is your silver and gold valued in dollars then? And why does everyone see it as that? You just can't go out to a dealer and say, well, ignore the fiat, right? Ignore the dollar amount. I think is worth this. They're going to laugh at you, right? I mean, this is obvious. Everyone should be knowing this. Now, your metals aren't going to be worth anything in the crap hits the fan scenario, the doomsday apocalypse, which I don't think is going to happen. Okay, let's just be honest. Historically, that is just so rare. I mean, to say that we're so special during this time that it's going to happen for sure. I mean, that's just so arrogant, and you're basing that off of, opinion. Okay, so now another thing too is you can't eat silver and gold, right? And if shit really hit the fan, there's no agreed upon spot price to rely on for fair market value consideration for your metals. In this Mad Max scenario that these gold bugs, silver bugs are mapping out, this Mad Max scenario, that no one's going to agree how much your gold or silver is going to be worth. Not only that, again, no one's going to care about your. What they are going to care about is gas. They're going to care about bullets. They're going to care about food and water. At that point, no one's going to care about gold and silver. That's not going to be valuable. Another thing too is it's hard to transport large amounts, and there's a higher risk of privacy breach when you're traveling around with large amounts of metals, right? Now, again, people won't value the gold or silver the same if crap hit the fan, which I don't think is going to happen, but it's important to map this out to contradict their narratives. Now, one last thing that none of the gold bugs want to acknowledge, okay? The statutory price of gold in the United States is around $40 an ounce. So at any point, the government can implement the statutory price of gold, and by law, your gold is only worth this amount, okay? That's the one last thing they will never want to acknowledge. And if you do bring it up to them, they will bury their head in the sand. So between all of this, I mean, between all of the returns that I was showing you, the math, how the math doesn't add up to the narratives that you're being pushed by the gold bugs. In fact, if you do the math, you start to realize you've lost opportunity. That is an opportunity cost where your money was dead money in those metals. Your money would have been better off either in the stock market or just putting that money into a cash flow, right? So instead of hoarding these metals, you could have been deploying that capital, right? So we got to start, ignoring these gold bugs. I mean, how long do they have to be wrong until people start to realize that these people are full of it? Okay, so again, I mean, to recap, the math doesn't add up. The narratives don't add up to the math. It's not a hedge on inflation. As I was showing you, inflation has outpaced the returns on your gold and silver vastly. Okay. Now, another thing too is, let's just be honest. Most people, they bought their gold and silver back around 2020 or 2021. Okay. It's not like you got in when gold was $20 an ounce, let's say in the decades ago. That's not most people's situation. We have to be realistic here. We have to realize, just like my story of my client, most people bought gold and silver because they started to listen to the Doomsdayer on YouTube and Telegram back in 2020, 2021. They thought the world was going to end. So a lot of people, they bought at the peak. And since then, they've lost money on their returns. So why hasn't gold and silver's returns gone up dramatically during this high inflation that we've been in the last, from 2020 to 2022? The last couple of years, all of their narratives have been wrong, and it's been provenly wrong over time. So after all that said, how long are these doomsdayers gonna hold on to the narratives and never admit that they're wrong? I don't think they'll ever admit to their failure in prediction. I don't think they will ever admit that they've been wrong for years and years and years. Nothing they said actually happened, right? So, in summary, again, it doesn't line up with where we are right now today. All of their predictions still up to this day have been wrong, and they're still doubling down on the same narratives. Okay. If you do the math, you go back, do the math, doesn't add up. Second of all, these guys are full of conflict of interest. Okay. They're selling you fear porn. They're selling you a narrative. They're selling you books. They're selling you courses. They're selling you seminars. They're selling you views. They're trying to monetize your views on YouTube. So look, it gets a lot of attention, right? This fear-based rhetoric. But again, it's all rhetoric. Let's go back, look at the data for ourselves. As you can see, what have I presented? It definitely contradicts everything that they've said. So if you guys want to learn more about what we do at Safe Haven, you can visit the website safe-havenco.com. And I'm also going to make this presentation, the Excel worksheet I was showing earlier and the PDF of the presentation will be included in my Telegram channel. So go back, so go in, take a screenshot of this QR code. You can join my Telegram that way. And then in the Telegram, I will have these resources linked for you guys. So you can go look at it for yourself and make your own decisions, okay?